Hello friends. Welcome to our channel. There are only two things in life that are guaranteed: death and taxes, as the saying goes. While the former is beyond our control, there are numerous tactics we may use to lessen the impact of taxes on our budget. In this post, we'll talk about some clever tax preparation techniques that can increase your savings and help you stay away from costly blunders. 1. Start early. Starting early is the first essential element of wise tax planning. It's crucial to start thinking about taxes far in advance of the end of the year because many tax-saving options are needed for prior planning and preparation. This entails maintaining accurate records of your earnings and outlays throughout the year, keeping abreast of modifications to tax rules and regulations, and seeking advice from a tax expert as required. 2. Maximize your deductions. Maximizing your deductions is one of the best methods to lower your tax obligation. This covers things like company expenses, healthcare costs, and charitable contributions. Keep thorough records of all your costs throughout the year in order to take advantage of these deductions. You should also be aware of the limitations and requirements that each deduction entails. 3. Contribute to retirement accounts. Another wise method of tax planning is to make contributions to retirement accounts like an IRA or 401k. With these accounts, you can grow your money tax deferred, deferring taxes on investment profits until you withdraw the money in retirement. Traditional retirement plan contributions are also tax deductible, which means they can lower your taxable income for the current year. 4. Consider a Roth conversion. Consider a Roth conversion if you have a regular retirement account. In order to take advantage of tax-free growth and withdrawals in retirement, you must convert all or a portion of your standard retirement account into a Roth IRA. Although you must pay taxes on the converted amount in the year you make the conversion, there may be significant long-term tax savings, particularly if you anticipate being in a higher tax rate in retirement. 5. Take advantage of tax credits. There are several tax credits that are available in addition to deductions that can help lower your tax obligation. These include deductions for energy-efficient home upgrades, childcare costs, and educational costs. It's crucial to comprehend the exact requirements and restrictions for each credit in order to benefit from them. You should also keep thorough records of any expenses you make that can qualify for a credit. 6. Don't forget about state and local taxes. Finally, it's critical to keep in mind that taxes are a global issue. Your finances may also be significantly impacted by state and local taxes, so it's critical to comprehend the unique laws and guidelines that apply in your state and municipality. 7. Check your tax code. How much tax AMRC will deduct from your salary is determined by your tax code. It is listed on your payslip. To make sure your tax code is appropriate for your circumstances, check it annually or after changing employers. In our guide to comprehending your tax law, learn about the most typical ones. If you're on the wrong code, you could be able to get a refund for prior years or pay less tax in the coming months. 8. Claim tax credits. Child care providers, disabled workers, and other low-wage workers receive additional funding from tax credits. You can claim working tax credits and child tax credits as your two primary categories. By 2024, tax credit recipients are expected to transition to universal credit. You can submit your application earlier, but if you are already receiving universal credit, you cannot claim tax credits. 9. Pay into a pension scheme. Your gross pay, before any taxes are deducted, can be used to make contributions to your employer's pension plan, as well as any additional voluntary contributions you want to make. The government will provide tax relief to your pension, giving you a free incentive to save for retirement. To calculate how much you could save, use our calculator for pension tax relief. 10. Get a season ticket loan. Some businesses will provide you with a tax-free loan to purchase your season ticket, which might result in hundreds in reduced travel expenses. Find out if your workplace participates in the program. 11. Claim tax-free childcare. You can get a 25% reimbursement of your childcare expenses through the tax-free daycare program. You must first create an online account that will be used to control payments to your childcare provider before you can proceed. The government will contribute £2 for every £8 you invest, up to a maximum of £500 every 3 months, or £1,000 if a child is disabled. You must fulfill certain requirements, such as having a child under the age of 11 and making less than £10,000. 12. Get a company car. If you are eligible for a business car, think about whether taking a cash equivalent in compensation might be more tax efficient. 13. Switch to a low-emission car. When replacing your corporate vehicle, think about a low-emissions model. Compared to vehicles with a high CO2 rating, these are now taxed at a lower percentage of their list price. Until the end of 2024 to 25, the tax rate for company cars will remain at 2022 to 23 levels. 14. Maximize your personal savings allowance. If you're a basic rate taxpayer in 2023 to 2024, you can earn £1,000 in interest on savings tax-free. Your tax-free allowance if you pay a higher rate is £500. Only savings income that exceeds this amount will be taxed. The savings provider will no longer automatically deduct this from your account. If taxes are owed, you must pay them through self-assessment or have them withheld through PAYE. Remember that if you pay taxes at the additional rate, 45%, you won't receive a savings allowance. 15. Make the most of your ISA allowance. Everyone is eligible to use their annual ISA allowance that is tax-free. You are permitted to fund ISA accounts with up to £20,000 for the tax year 2023 to 24. This has not changed since 2022 to 2023. All of this can be invested in a cash ISA, a stocks and shares ISA, or a combination of both. In our guide to ISA regulations and allowances, we describe how this operates. 16. Use the starter rate for savings. You may also be eligible for the starting savings allowance if, in 2023 to 2024, your income from a job or pension is less than £12,570, but you gain income from interest on savings. 17. Self-employed car costs. In general, you can deduct the operating costs of an automobile you use for work, but not the cost of purchasing one. You can deduct a portion of the overall costs if you use the same car for personal use. You can either claim a set rate mileage allowance for business travel or sum up all of your motor expenses for the year to determine the percentage of business miles you actually drove. 18. Annual losses. You can carry over a loss from one tax year and use it as an offset against profits from a subsequent year that is more profitable. As a result, your taxable income drops. That concludes today's video. I sincerely hope you enjoy this video. If so, please subscribe to our channel and click the bell symbol to see more. Enjoy your day and thanks for watching.